Hello and welcome. My name is Austin if you're new here, and I'm a certified financial planner practitioner. And on this channel, we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. Today, we are going to take a deep dive into what market timing actually entails and why it's more difficult in practice than the benefits we're hoping that it provides. So in this Vanguard research, they suggest that in order to be successful with market timing, you have to be right not just once, but at least 5 times. So number one is that we have to identify a reliable indicator of short-term market returns. So it's important to ask how you formulated your opinion that tells you now is a good time to be selling. Because most people formulate these opinions by watching the news or reading online articles or listening to the radio or talking to friends. And it's important to ask yourself if you have a qualified source to look to for accurate short-term projections. Number two is you have to time the exit from the market down to the precise day. And so why does that matter? Well, because the best and worst trading days tend to happen close together. So if you time it wrong, you could miss some of the best trading days in a given market cycle. Number three, you have to time the re-entry into the market down to the precise day. And that's for the same reason as before about missing some of the best days if you time it wrong. Number four, you have to decide on the size of essentially how much money you are going to trade, because how much you decide to move could directly impact how much is on the table for gains or losses. And number five, you have to execute the trade at a cost that's less than the expected benefit. So totaling up costs like your trading fees, your mutual fund loads, your ETF spreads, and even in the case of a non-retirement account, right, you have to know what the tax impact of your trade is going to be. So let's take a look at another chart here, and we'll put this into practice as an example. So this chart shows the growth of $1,000, okay, based on the period of time between 1992 and 2018. And so if we look at the results, we can see the impact of how successful an investor was based on their market timing efforts, right? So we can see the difference in result of someone who was right 50% of the time, someone who was right 75% of the time, and someone who was right 100% of the time. They successfully predicted all economic surprises. And so one thing that's interesting to note is that if you were right 75% of the time, you actually only had a difference of $252 from the base case of if you had just invested in a 60-40 portfolio during the whole time. So not an enormous difference. And what's not included in this study was the trading costs. And if they had been, then the returns of the market timing strategy would have actually been lower than the base case. So I thought this was an interesting study. This is another chart that shares some perspectives. This shows that the average return of a bull market is about 99%. The average return of a bull market, and the average return of a bear market is about negative 28%. But it's also interesting to note that bull markets on average are about four times as long as bear markets, right? The average length is typically 4 times longer. I mean, you look at these blue areas and they're quite a bit longer. So the time we spend in a bear market is a fraction of the time that we typically spend in bull markets. And I think this helps provide perspective if we're trying to time our way through the bear market, because many bear markets are over before we know it, or before they've even been declared a bear market. I'll share one last study that was interesting that sampled 9.1 million self-directed Vanguard investors from January of 2022 through May of 2022. And if you were invested during this time, you knew it was a volatile time in the market for sure. But of the 9.1 million investors, 87% of them made no changes to their portfolio during that time. And only 13% did. And of that 13%, only 4% actually sold investments. The rest were actually purchasing more stock at that time. So that tells us that 96% of investors stayed the course or invested more during that time, while only 4% actually sold their investments. So if you were among the 96% that held tight during that turbulent time, then you were in good company with the vast majority of others who did as well. So there's nothing wrong with making changes to your portfolio on occasion, but it's best if those changes are based on the headlines in your life and not the headlines in the news. I hope that this research has helped you further understand the real-life complexity that comes with market timing, and it encourages you to follow more time-tested and proven strategies, such as developing and sticking to a plan, keeping a long-term mindset, and regularly rebalancing and staying diversified, because I know that these will give you the best chance for investment success over the long run. Thank you for watching, and if you have questions about what you've learned, click the link in the description to learn more about our firm and how we can help.